Well, good morning, traders and investors. My name is Roger Scott. I'm the head trader of Wealth Press. Today is Tuesday. I thought for a minute it was a Wednesday, but it's actually Tuesday, the 26th of January. It's the last trading week of January. We got earnings, vaccines, stimulus, and the virus causing havoc. Let's get into it. Let's try to make some sense of all of it. Let me give you guys a good idea of where we stand, what's driving the market, what the upside and the downside is. Again, my job here in the morning is to get you guys ready for the day and kind of give you the issues that I'm seeing or the hurdles that I'm seeing ahead of the day. So, broad market retreated in Asia, driven by renewed worries that trouble with COVID vaccine rollout and the spread of new variants of COVID vaccine might delay recovery from the pandemic. We're seeing another variant, and it seems to be a lot. It seems to be very easy to infect people with this variant in comparison to the first one. It seems like once you're infected, it's the same story, but it's twice as easy to infect. So now they're worried whether the original vaccine is going to protect people from that. Rising COVID infections in various countries like China, like Beijing, for example, where it all started. Remember I told you we're going to see a repeat of 2020 and 2021 unless the vaccine comes first quarter and it's not here? I hate to say I told you so. The spread of a variants that are thought to be more easily transmittable might be less effectively targeted by the existing vaccines, and that is the problem. So again, if we find out that the current vaccines aren't as promising against the new variant, can you imagine what we're going to go through? It's going to be a repeat of what we saw last March, April, and May, and I hope it doesn't happen, but I'm telling you right now, the market is not happy right now. It's setting itself up for some unpleasant trees, which is why I'm here to talk about this today. Earnings, more than 100 companies in the S&P are scheduled to report this week. We've got American Express, we got Johnson & Johnson, we got 3M, AT&T, Tesla. All the big names are reporting this week, next week, and to a lesser degree the week after. Last week we only had about 50 report, but this week we've got a bigger flow. By the end of this week, we'll have a good idea of where we stand in terms of earnings. As a whole, analysts expect the S&P 500 companies to say their fourth quarter fell 5% from a year earlier, milder than the 9.4% expected. But remember, these expectations are a moving target, okay? We've had plenty of time to revise them. So again, you want to see the difference between what the expectation is and what the actual is, but don't get too focused or too targeted on the actual number, because again, that gets plenty of time to be revised. Coronavirus pandemic is worsening and doing more damage by the day, especially in Europe and China. A UN agency said Monday that 4 times as many jobs were lost last year as in 2009 during the global financial crisis, which is why we have so much stimulus on the table. Federal Reserve will begin a 2-day meeting today, the FOMC. We're going to hear about it tomorrow. We're going to see how things go. We also have consumer sentiment, not consumer sentiment. Let me make sure. Let's see here. Is it consumer sentiment? Let me see what we have at 10 a.m. today. No, durable goods. We have durable goods that's tomorrow. I'm sorry, folks. Consumer confidence. I'm already on Wednesday. Today's only Tuesday. Yeah, I keep thinking today is Wednesday. I actually had to start this video again because I thought it was Wednesday. So we got consumer confidence coming out at 10 a.m. Consumer confidence is going to be a big indication of how the GDP is going to do on Thursday. So keep your eye on that. The biggest reports are going to be the FOMC tomorrow afternoon. Expect the bond markets to move. Don't be fully loaded tomorrow around this time because there's typically a good amount of volatility. Less than usual, I'll give it that tomorrow because the FOMC, there's not going to be any major expectations other than, yes, we're going to keep rates where they're at for prolonged period of time. But the big reports are going to be the GDP and jobless claims. And if the jobless claims, folks, are near 900,000 or a million, oy vey, it's not going to be good. I'm hoping that we have a surprise number and it's going to be below the 4-week moving average. But it was 900,000 last Thursday. The Thursday before that, it was 965,000. And remember, these numbers are not delayed. This is from the 23rd. This is just from a few, 5-10 trading days ago. So these numbers are live numbers. So again, GDP is coming out on Thursday. Jobless claims is coming out on Thursday. New home sales, I really wouldn't worry about. Existing home sales were at a 14-year high. But again, consumer confidence today is going to be very telling on what we should be expecting on Thursday. So pay attention to that report. Now, looking at the market, looking at individual stocks, I want to show you guys something important. And this is something you guys should pay attention to. Look at the 10 major sectors. Now, typically, there's patterns here. I'm showing them to you from strength to weakness. Notice financial is leading. Notice that consumer discretionary is almost at the last spot. That's bad. That's not a good, that's very, very bad. And notice consumer discretionary and technology are apart from each other. Usually they're right next to each other. That's telling me that the market is becoming fragmented. And that means it's becoming out of whack. When the markets become out of whack, things can get nasty. I mean, look at financial sector. It's rising right now. Look at a 2-year chart. This thing just broke above the last February high and it's already cooling off. Not so confident in the financial sector. And if you look at the energy sector, look at this thing. Look at where it is now. It's near 40 and we were near 60 when we broke in last February and March. So, or 55, sorry, 55. But we kept breaking lower to begin with. So I'm not really confident in either the financial or the energy sector. I need to see a lot more upside from the financial sector a lot faster. That's not going to happen if the Fed data, if the GDP at the FOMC, and if the jobless claims, and if the consumer confidence is not positive. So there's a lot of ifs there. Also, the fact that leading stocks like consumer discretionary and basic materials and industrial are not in the first spot, and defensive stocks like utilities are starting to lead, that's a bad sign. Now, let me show you some other sign. Now, this should be eye-opening. This is the cash. This is the S&P 500 cash. Where's it going? This is not a trick question. Take a look at it real quick. Where is it moving? Look at the trend line. Look at this. Higher, right? Higher. There's no question about it. That's an all-time high right there. Now I want to show you something else. Now, this is the NASDAQ 100, right? Look at the NASDAQ 100. Number of stocks trading above the 50-day moving average. Look at where we were. We had 88 stocks trading above the 50-day moving average around the start of the year. All right? 88%. Almost 90% of stocks in the NASDAQ 100 were trading above the 50-day moving average. All right? Follow along. This is important. Now, you have 66 or 70%. So you had almost 90%. You had 88% of stocks in the NASDAQ 100 trading above the 50-day moving average. Okay? There's only 100 stocks, and 88 of them were trading above the 50-day moving average. Now, you have only 70. You have 18 less stocks trading above the 50-day moving average. Meanwhile, price continues moving higher. So you have less stocks causing the market to go higher. Look, it's right here. This is the NASDAQ 100 and this is the NASDAQ 100. And if you think this is the futures and there's a trick here, let me go to cash. Here's the cash. Same thing. Look, let me just adjust this a little bit. Here you go. There it is. All-time highs right there. Higher, right? Higher price. Well, here's the NASDAQ cash. Here's the cash. And here is, where is that? Where's that chart? Here, let me just go here, make this cash. Sorry, I made the wrong, I got overexcited. I'm getting too ahead of myself. So again, higher price, all-time highs. But what about number of stocks? See, when you're looking at price action, it says one thing. But when you're looking at momentum, internals, they're telling us something different. What it's telling us is there's 18 less stocks trading higher than there were when the market was making all-time high in December, right around right here. Right here, right there. When we were right here, 88 out of 100 stocks were trading above the 50-day moving average. Right here, less than 70, or about 70% of stocks are trading above the moving average. So imagine you're driving a car and the car has 8 cylinders and it's driving 50 miles per hour. Now the car is driving 60 miles per hour, but only 6 out of those 8 cylinders are working. That's what we have right now. And that's bad. That's not good, folks. That's bad. Bad, 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 bad. You've got less stocks driving the train higher. And that's narrowing of momentum. And that was one of the biggest signs that the market was cooling off last time around. In addition, you also have divergence. Look at the RSI. Highest high, we can barely get above 70 here. Whereas here, when we were at 301, we went all the way to 85. So you have divergence in RSI. RSI momentum levels can't go higher. And you have narrowing of momentum. It's right here. And again, this is not a theory. This is not an opinion. This is not what I think. This is reality. You have less stocks. Here, you had 88 stocks trading above the 50-day moving average in the NASDAQ 100, 100 stocks. Now you have 71. 88 versus 71, market's going to go higher, right? Doesn't make any sense, does it? Well, folks, what happens eventually is it catches up to us. Just like that car engine that you're driving at 60 miles per hour instead of 50, but now it's working on 6 cylinders. Eventually, it starts working on 4 cylinders and 2 cylinders, and then it crashes. So let me show you what you're seeing now is exactly what you saw before that crash that we had. So be very, very cautious. You've got sectors out of whack. You've got narrowing of momentum, and you have divergence. Not good signs at all. Now, I don't want to discourage you, but there's a good chance we're going to have a little short-term corrective action, and it's much needed to bring the strong, to force the weak hands out and to bring the strong hands back so the market can keep moving higher. But narrowing of momentum is not a good sign. Now, folks, the stock market can be unpredictable. It is right now, especially given today's social and political climate. And that's why you need a trading strategy that will net you consistent returns year after year, no matter what life throws you. Narrowing of momentum, divergence, a solid system will make money no matter what happens in the market. That's where trophy trades can help. It can help you no matter what life throws at you, folks. This stress-free trading strategy allows you to capture more of the stock's gains without leaving large profits on the table. Who wants to leave large profits on the table? Nobody. Nobody. What people want is consistent returns year after year. We do not want turbulent markets. We want to be able to make money in turbulent markets. This stress-free trading strategy allows you to capture more of a stock's gains without leaving profits on the table. And again, here's the best part. It works in every kind of market environment, diverging, narrowing of momentum, and it works in the most turbulent of markets. It's got an amazing track record. Click the link below, check it out for yourself. You've got to learn more about trophy trades. Do it now. And have a great day. Bye, everyone.